ESPN Plus, they're going from a model which is impossible to do better than. They're going from a model where ESPN is watched by 20% of the people, but they get $7 a home across the entire cable and satellite universe, including the 80% that barely watch it. To go to ESPN Plus, where the only way you derive value is selling it to somebody who's going to use it, they're going to do okay with that, I have no doubt. But it can't be as good as the existing model that they're coming from, which is in decline. And the real issue is how fast is that decline on the existing business relative to what they can make up here. They had some nice sub ads, but just to make up for their Ultimate Fighting Championship deal of $300 million, of which ESPN and ESPN Plus split that, 150 million going there. They probably need 3 million subs just to cover that one rights contract. So you really got to look at now how they have to cover rights cost against something where they can only get revenue from the people who are actually going to watch.
It sounds like you're on the fence in terms of whether or not the new streaming business will be able to offset declines in the core.
Well, it's complicated because it isn't a streaming service. It's three. It's right. ESPN Plus, Disney Plus, and Hulu. And you have question marks on all of them. Hulu, you got this huge issue that I don't think anybody's digging into. 40% of their adult play is owned by their two biggest competitors, Comcast and AT&T. We really don't know if they have any kinds of decision-making or governance control, how that's going to be unwound. It isn't going to be, hey, we just walk away from that 40% interest. And that's going to be their major non-kids opportunity to chase Netflix with. So I really think there are a lot of question marks here on all of them.
Tom, math, though. Help me out with some math. Can you help me out?
I don't know. Depends on what kind of math.
Is 5 more or less than 7? Right? 5 is, and ESPN Plus, Mike, you know the answer to this. Okay. Yes. ESPN Plus charges $4.99 a user. They're getting $7 for the cable company. So if Santoli cuts his cable, he wouldn't because he works for Comcast, but you know the point. If he cuts his cable, they lose 7. He signs up for ESPN Plus, they gain 5. They're losing 2 in that transaction. Do we have any idea how many people are using it as an ad? They've got cable and they do ESPN Plus. Otherwise, it's a net loser for Disney.
That's a huge question. And how many people are going to use both ESPN and ESPN Plus? My guess is there's a decent overlap there. But you have the equally big issue of all these skinny bundles where ESPN will make its way into some of them as people cut the cord and go to these packages of much smaller numbers of channels. But there'll be plenty of people taking skinny bundles that have no sports in it at all because those are going to be the lower cost. And that's where they really take the hit because today they're getting paid across all cable and satellite subs.
We live in a world, though, where Netflix has relationships across the world with 150 million customers, and it's a $155 billion market value, right? So no one would ever say that Disney's streaming service would get that kind of multiple. But if it's not a zero-sum game, in other words, you either lose a cable sub to gain another one, are they decently positioned in terms of the franchises, the brand, the fact that they can, basically make $1 billion box office movie seemingly like whenever they want?
Well, there's no doubt they are a studio powerhouse. They were before with the acquisition of the Fox movie and TV studios even more. So their production capability is huge. But the Netflix issue, I think, is one that they got to get away from. To your point, no one can catch Netflix. And I don't think Disney can begin to catch Netflix. But they don't need to catch Netflix here to create a asset value that really helps to deal with the issue of the core business decline. The question is, how much are they really going to invest there? Nothing about this earnings report really gave us a clue about that. They're going to have a major issue in terms of foregone opportunity on all the licensing that they're no longer going to do. But that's even a sub-point to some extent. We know what drove Hulu so far. It's originals, Handmaid's Tale. What drives Netflix? Disney's Avengers Infinity Wars on Netflix. People don't talk about that as the reason they watch Netflix. They watch Netflix for the originals. And that is a massive additional spend. We don't really have a clue yet what they're prepared to do there. And the issue of what valuation they get is all about how long are those losses going to last, how deep is that cash hit going to be, and ultimately when do they turn profitable. If that's 10 years out and you're discounting that back today, you're going to get a very, very different looking asset value than the $150 billion that Netflix sees today.